Today, I want to talk about the new ruling that says Ken Griffin himself must pay for the squeeze. That responsibility won't lie with the DTCC. It won't lie with other member firms. It will lie solely with the market maker that's defaulting or with Ken Griffin himself. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, this is to do with those market makers or clearing organisations and their recovery and wind down plans. And the Securities Industry and Financial Markets Association has just left some very interesting comments. First off, the SIFMA, or Securities Industry and Financial Markets Association, is a collection of people, hedge funds and institutions, or a union of sorts. This is a collective voice writing a letter with comments to the SEC and to the CFTC. But what do those comments say? Well, the first comment is about clearing agencies and market makers being required to post and collect intraday margin from trading platforms, from each other and from their customers. Their comment says intraday margin, both initial margin and variation margin, should be affirmatively required to be collected from any clearing member whose start of day margin has become insufficient as a result of position changes or market movements. Saying failure to collect and maintain adequate margin from one clearing member transfers the risk of that deficiency to other clearing members and market participants. Basically saying the SEC and CFTC should not issue any waivers of margin requirements to any hedge fund, market maker or market participant. We know this was the key issue back in January 2021 when the CFTC effectively waived a $3 billion margin requirement from Robinhood. And this Financial Markets Association is saying to the SEC and to the CFTC, you must absolutely not do that again. Saying initial margin requirements should be robust and transparent so clearing members may reasonably anticipate margin calls. Saying margin models must be transparent and predictable and no margin waivers should ever be offered. And that's effectively so these clearing agencies can properly implement their wind down plans if they do indeed default. They've obviously noted a disorderly failure of a clearing agency or market maker would likely cause significant disruption in the markets, and therefore ensuring that other clearing agencies or other market makers can continue to provide critical operations and services as expected, even in times of stress, is therefore central to financial stability. And they've also said the procedures should clearly distinguish between the treatment of default losses, resulting from the failure of a clearing member, and non-default losses caused by the clearing agency's internal business decisions. Basically, if a market maker does fail, they need to distinguish that loss between the loss attributed to the market dropping by 5 or 10% and the loss attributed to the market maker's stupid decisions. Basically, if a market maker is taking stupid risks, that should be distinguished from normal risks. Say, if a market maker is holding long shares of Apple, and if a market maker is committing illegal crimes synthetically shorting AMC. And they've said those losses attributable to normal risk, like holding Apple stock, should be borne by other clearing members and other market participants, and that loss is shared. But any losses arising from stupid decisions should be borne by the clearing agency or market maker themselves. Basically saying that if Citadel collapses as a result of illegally synthetically shorting AMC, Citadel themselves should pay for that loss. And to do so, Citadel and other market makers may need to solicit their own shareholders for meaningful contributions to the default waterfall. Basically saying if Citadel collapses as a result of synthetically shorting AMC, Citadel will need to raise the money to pay for that squeeze on their own, through their own shareholders like Ken Griffin, or from other market makers, other firms, other institutions, or anyone else out there. But so why does the Securities Industry and Financial Markets Association want to differentiate between normal losses and stupid risk losses? And also, why do they want collateral and margin requirements to be posted and met at all times and never waived? Clearly there must be some clearing agencies or market makers out there that are holding stupid risk that needs to be separated. And maybe that risk is about to explode and they need this ruling passed beforehand. You can currently get a guaranteed free share of Tesla or of Google and up to 15 free shares on top of that, each worth up to $2,000, which you could always use to buy more shares like AMC, GameStop or of any other stock. All you have to do is sign up to Moomoo using the link in the description below and make the required qualifying temporary deposit. Signing up to Moomoo is free and it's easy, it just requires that temporary deposit, but it's a really great way to help support the channel. On top of that, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools and their own options trading platform. G-Man has also tweeted the reason as to why Toys R Us was up 1,400% on the day yesterday. He tweeted saying Toys R Us, which went bankrupt in 2017 due to predatory short selling and seller boxing by Wall Street hedge funds, saw their stock price explode 1,400% yesterday. After news broke, they plan to open up to 25 new stores in the United States. It seems Toys R Us is coming back with plans to open up to 24 flagship stores, along with shops in airports and on cruise ships. It seems Toys R Us is quite literally rising from the dead, which is likely going to drag their stock price up too, again creating even more risk and even more margin requirements for these hedge funds. All of a sudden that short position that was 99% in profit is going to dwindle more and more, reducing their unrealised gains, creating more unrealised losses. The company that bought Toys R Us out of bankruptcy has said that Toys R Us is growing fast and our expansion into air, land and sea is a testament to the brand's strength. And Phil For Real has also tweeted about Adam Aron's potential next snatch, which is with Lady Gaga. This article says Lady Gaga's concert film for the Chromatica Ball Tour is well on its way. Maybe this is yet another live action concert film that will be signed by AMC to be distributed not just across the US, but distributed worldwide. And it will be distributed not just in AMC cinemas, but in cinemas around the world, which would be massively profitable for Adam Aron and profitable for AMC, with a massive margin. This is yet again another huge artist that would likely sell hundreds of millions of dollars worth of tickets for AMC. And the AMC ape has also tweeted the reason why the mainstream media isn't documenting AMC's movement into the distribution industry. He tweeted saying literally no mainstream media articles have come out about how AMC is entering the distribution industry. He said this is a massive addition that can generate hundreds of millions, if not billions of dollars in profit, but apparently it's not news. And the reason why is because not only does this not fit into the short sellers and mainstream media's narrative, it actually goes completely against their narrative. The mainstream media and the short sellers want to give you the impression that AMC is going bankrupt, and that's why they only publish articles about how Taylor Swift and Beyonce can't save AMC, and why they would never publish articles about just how much money this could generate. This is likely to generate hundreds of millions of dollars, if not billions of dollars in profits, and that's why it won't be published by the mainstream media, because it quite literally destroys those shorts. Speaking of which, Beyonce's Renaissance movie has become so popular, customers are having to wait in line or wait in a queue to buy tickets. AMC has been experiencing such high traffic volume, they've proactively created this queue for all visitors. That's because so many customers are trying to buy tickets for this showing at AMC theatres that it's literally crashing the website, and that tickets are selling out faster than you can imagine. Now you may say, okay Tom, that's great, AMC is generating hundreds of millions if not billions of dollars in profits, and the SEC, the CFTC and the association are trying to get these market makers that are about to collapse to at least separate their losses. But what exactly is going to trigger these market makers to actually collapse? You may say, Tom, you've been saying these market makers are going to collapse for ages, but what is actually going to trigger it? Well, as Donahue George has tweeted, he's asked, are the banks that are down $600 billion, if not more, willing to continue high-risk loans to AMC shorters? We know Bank of America has a $100 billion paper loss, and many other large banks and regional banks have tons of unrealised losses too. And we know those unrealised losses in banks specifically are now becoming realised. These are currently unrealized losses because they know customers will default, but they haven't yet defaulted. But now many of these customers are starting to default, and defaults are at all-time highs. Especially those defaults in the credit card market, the auto market, and now student loan market, and soon in the mortgage market as well. And as these losses turn from unrealized to realized, these banks are going to be losing hundreds of billions, if not trillions of dollars. And will these banks that are currently losing hundreds of billions, if not trillions of dollars, continue high risk lending to risky hedge funds and risky illegal shorters? Or more likely, will they pull those loans? Will they pull that funding? And will they cause margin calls? You have to remember, Wall Street is a dog-eat-dog world. These banks are going to do whatever is in their best interest, regardless of who it impacts. Bank of America manage more than 90% of Citadel's margin loans. With Bank of America's $100 billion plus loss, are they really going to continue lending money to a risky hedge fund and market maker like Citadel? Or will they save their own skin and pull that money back, margin calling Citadel, getting their money back and causing a Citadel collapse? So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.